No two investors have identical situations. They each have different objectives, time horizons, risk tolerance, and financial positions. A long time ago, investors thought that each individual should have a different investment portfolio. For instance, they might look at me and say, "Armstrong, you're old, so you should only buy bonds, preferred stocks, convertible bonds, real estate investment trusts to produce income." The trouble with that approach was that it led to badly performing portfolios that carried much more risk than necessary to meet the individual's objectives. James Tobin looked at the problem from another direction. He stated that the big difference between investors was their tolerance for risk and their need for liquidity. He believed that somewhere out there was a perfect equity portfolio, which he called the super efficient portfolio. This portfolio would generate the maximum return per unit of risk. For every investor in the world that wanted any risky assets, they'd want to hold that portfolio. If they needed liquidity or had a low tolerance for risk, they could water down that portfolio with the local zero-risk asset, which in the United States is the Treasury bill. If that portfolio wasn't risky enough for them, they could buy it on margin. All investors could form their perfect portfolio for their individual needs by simply balancing these two assets in the proper proportion. Tobin called this the separation theorem, which among other works won him the Nobel Prize in Economics. I simply call it the two-bucket theory. The Investor Solutions pension plans incorporate this key insight into their plan design. We hope we have what's a reasonable shot at the super efficient equity portfolio, and we allow you to balance that with a very conservative short-term bond portfolio to meet your exact investment needs. In our next segment, we'll discuss how to choose the right plan for you and your family.